All right, so hey everybody, excited to do this quick podcast with a buddy of mine. We're here at the Nixon Peabody office. We're going to talk about all things asset management, specifically with my friend Matt Bobrow. He runs the private funds group at Nixon Peabody. He's been a really huge supporter of the Sutton Capital Fund Accelerator program. And, we're going to talk about maybe a couple things that you want to think about as you're setting up the fund. There's a bunch of mistakes that, we've seen people make. So, sometimes it's good to just lead with problems and, be aware of them. A lot of times people are afraid of talking about problems and afraid of facing their demons. But I think just kind of facing these, concerns, especially head on, it helps so you don't make those mistakes. So number one, Matt, why don't you give a quick overview of, your role at Nixon Peabody, kind of the different funds that you've been helping, and then let's just talk about asset management for a little while.
No, thanks for the introduction, Joel. That's great. And, I think it's just very indicative of how important this topic is that we both thought about doing this topic before in advance.
Yeah.
And kind of just serendipitously, it was the exact topic each of us thought about.
Sure.
So, my role at Nixon is really to help fund managers, especially early stage fund managers, figure out how to set up their fund, form it, get whatever disclosure documents that are normally prepared for their investors, depending on the type of fund that they are, prepared and out to their investors in really the most effective and efficient way possible. So that's really half the practice. The other half is the LP side, where we're actually helping a large amount of investors and sometimes the world's largest investors get into different funds that we haven't formed, usually for conflict purposes. And so we're kind of seeing every angle of the market. We're seeing the upper end of the market, usually more from our LP side practice, and then the middle of the market and the emerging part of the market from our fund formation practice. So we're kind of well versed in explaining things that are happening and parts of the market that our clients want to get to them to help them actually get there. So yeah, do you want to start with the maybe top 5 things that early stage fund managers should be wary about, or do you want me to?
Yeah, maybe I'll list a few that I think are, that I've seen just based on examples when it comes to fund managers. I think the first thing is, how you position the fund. So if you're saying that you're raising $100 million fund and you've only and you haven't closed anything, or you closed like maybe 20 grand or something, then I think you have to kind of take a good look at yourself in the mirror and see if that's actually achievable. And, obviously if you're advertising that AUM, LPs are going to want to learn about what traction you had. So I think what definitely helps with managers is, trying to get some type of soft circle capital from friends and family and actually have some, checks coming in and show some traction. I think it's just a red flag if you're already coming out of the gate, with such a high AUM that you're trying to raise and you haven't, there hasn't been much traction. So if that's the case, maybe just position it to be a smaller amount. And then I think also it's just, especially with positioning, if your first fund was 10 million and then now you're saying your second fund is 100 million, that's a huge difference as well. So that's kind of a red flag, I think, when it comes to the capital raising standpoint. And I think having all of your ducks in a row with the documents and making sure that the terms are LP friendly, I think that's super important. I'm trying to think what else is there. Just being aware of general solicitation and the rules around that in terms of like what that means and how you're reaching out to LPs. Be careful. Don't ever, in my opinion, you're going to check me here, but you should never just send an email blast out to a bunch of subscribers saying that you're raising a fund because maybe you don't necessarily know them. But those are some of the hot topics that I've been hearing right now in terms of positioning, especially for the managers in market. But give me your rundown. Give me kind of because you talk to these managers and they're giving you their deck. They're giving you their maybe sometimes you have to redo their documents, and it's much easier probably to just start the documents from scratch in terms of kind of reverse engineer what they already have. I've seen some managers actually switch from an evergreen structure to a closed-ended fund, and that was a whole reorganization as well. But again, that's just what I've been hearing from my perspective, kind of being the the fund manager platform. But let's hear what you got.
Sure, sure. I mean, I'll start with some of the points you raised because I
Mm-hmm.
think they're important ones. The first thing that you talked about was sort of overestimating the amount of capital that you are going to be able to raise.
Yeah.
And I think it's a systemic problem, and I don't know that it's necessarily done intentionally as much as it is early stage managers. They don't necessarily understand the scope of their strategy and the amount of capital it might even take at the beginning when they're first formulating it. And so maybe they overestimate a little bit to say, okay, we're going to need about this much capital to really make the returns that we're going to look for, at least in this industry, whatever it is. So I think what is helpful to those managers is to really right-size the amount of capital that they're raising at the outset with whatever investor interest they've seen in comparable funds in the market for that strategy. So if you're doing like an energy fund that's focused on a certain set of the energy market, and most funds in that area are raising at least 100 million to be successful, the ones that you're seeing generate the returns you're looking for, then it becomes, that's the discussion point for the investor that you're trying to bring on. And when you tell them, hey, I've had 500,000 that I've raised, but we're shooting for 100 million. When you talk about the comparables and why your fund is similar to those funds, that kind of justifies a little bit why you haven't gotten to that point yet. We just started the strategy, but we're aiming high because it's necessary for it. And so I think, when you have fund managers that don't really have that justification, or when you ask the questions and you don't really get those answers, it's easy for investors to kind of see through the veil a little bit of what's going on. But yeah, so I think in terms of the materials that early stage managers are using, I think you raise a good point. Like, there's certainly a lot out there in the market where it's a little bit, I'll use the word exaggerated, or maybe optimistic as opposed to realistic. And there's nothing per se wrong about saying we're hoping to make this much in returns, right? But you need to have some type of evidence, some type of track record, something to show, like comparables, even like I was just talking about, even if you don't have a track record. Like, we're talking about a strategy that is nearly identical to this fund that does have this track. And those are things that pretty much any early stage manager, if they take the time, could do properly. So that's just a few things on what you mentioned. And I think what you kind of hinted at is I am seeing a little bit deeper into the process. And so one thing that I would call out too is there seems to be and this is kind of across different industries, across fund sizes at the early stage manager sector, is there's a little bit of a light touch when it comes to the due diligence on the investments. And I think that is an area that a lot of early managers could improve upon. And it's something that when we flag it for them, it's like you kind of see the light go on, like, hey, okay, yeah, like we could definitely do this a little bit
So
better.
tell me a little more about that. So are you saying that in their decks or maybe in their way that they're pitching, they're not really going deeper in terms of how they get proprietary deal flow or how they're doing the diligence to source, pick, and win?
Exactly. I mean, you have some managers that are basing their strategy on who they know. And their deal flow is akin to the people in their network. And there's, in terms of due diligence there, you really shouldn't just say like, we're getting deal flow from this person, right? You need to kind of explain why that particular deal is one that you would invest in, and really dive into the revenue, the employee numbers, locations, and this will get into another point later about diversification, but you want to have a strategy that is consistent, but not necessarily not diversified. And I think a lot of managers, they think like, oh, we're doing early stage VC and it's this specific type of tech that we're looking for. And like, that's great. And, it's supposed to be a risky strategy. It's early stage VC. But you could also kind of balance it to some extent with certain different, maybe the West Coast and the East Coast. You don't just focus on the West Coast, or, you take a more globalistic view to your investing. I mean, there's different ways of sort of doing it depending on the strategy. So there's a few things there when you look into the details of what you're actually giving out to investors that I think are kind of key items I would have early managers just take another look at.
Got it. Okay. What else you got? So what are the other, tell me, I want to fall in love with the problems. Tell me,
Yeah.
tell me what are the other mistakes?
That's a good way to put it.
Yeah.
I think one thing that we just hinted on a little bit was managers that have pipelines of deals, and they're early managers that are relying on networks to be the fund. And that I think works to a certain extent, especially if you're successful. And just picking deals like you have a good network. But you don't want to have and this goes for really any business, not just fund managers. You don't want to have your business be just you, right? You want to have something that if you got abducted by aliens tomorrow, the business would go on and continue to be successful. So we don't have to have a strategy that is entirely unfocused on your network, but there should be some element to it that is systematic or at least I don't want to have to say algorithmic, but you're kind of looking at a situation where you really just need to put up front what are the basics of what you're looking to invest in. And this ties to the due diligence problem.
Sure.
Because I think sometimes there's not as clear of a strategy as there really should be. And this is another thing. We'll talk to clients about this, and we'll say, hey, would you invest in a business that was entirely just the founder? And if the founder went away, what would happen? And the obvious answer is no, right? So when they kind of think of it from that perspective, it starts to make sense. But so that's a huge one, and I think it's another easy one that early managers could quickly work on and start to improve.
I think you make a good point too. So I saw something in my feed maybe a couple weeks ago, and I think a concern is, I would say it's a red flag if you have a manager that is just really focused on building a venture fellow program, and they're really relying on only their networks when their fund should really be a flywheel, right? It should be a systematic mousetrap where they systematically do outbound to find great deals. They have their process to find deals. Obviously, they use their network, but they're kind of using this repeatable process that essentially turns into repeatable alpha. And I think if you always have this dependency on this angel group, or like you're depending on these college kids to be your venture fellows to hopefully find alpha, then there's a dependency. So I think and then to your point, there's key person risk, right? If you're the only person, and let's say unfortunately you get hit by a bus, that franchise, because when you're building these funds, you want to think about like a multi-generational decade franchise, right? Where it's like, hey, I'm building hopefully the next Blackstone. So that means if something happens to you, or you take on a more strategic role where like you're just going out to kind of raise more assets, the practice and the platform is still going to continue to source, pick, and win deals that are going to generate outsized returns. And then when you look at the portfolio from the top line growth, hopefully it's a machine that continues to do that, and that should hopefully help people be attracted to think about fund two.
No, I agree, and I think the way the adjustment to look at it is, it shouldn't be that your business can just, especially at this point, just succeed automatically without you.
Yeah,
it's just your role should be to work on how to find the best investments.
Yeah,
and not just through your network, but in terms of the due diligence that you're doing on those investments. And then being able to see, okay, maybe it's 80% of the time, if I have a company like this, in this type of market, I'll be able to generate this amount of return after this amount of years. But if you're thinking about it not in that way, and it's more just the way I'm adding to my business is I know somebody who works next to person famous X, Y, or Z, and that person gets priority on some deal, right? Then sure, maybe that works for a while, but it's not as sustainable as really.
And you don't even need to exist, because you're essentially just kind of investing off the platform of someone else that's done the work of doing
You're
the diligence.
Rider, right? Which and also isn't a great situation to be in when something happens and you haven't done your diligence and you're kind of caught like, oh man, that was kind of obvious and I just relied on this person.
And you may be relying on their diligence too, right? So a lot of these angel groups, they take a lot of time to write a great memo because they're trying to close a syndicate. So if you just copy and paste that, or just kind of go by that, I think that's an important point. So a lot of people, some angel groups actually have, this is crazy, but some of the angel groups have founders write the memos. So you're just kind of going by, hey, we're a $2 trillion TAM. So you're just assuming that's the TAM versus going out and doing really extensive research on like maybe, what is the TAM, the SAM, and the SOM when it comes to competitors, who are the indirect competitors. So really just kind of peeling back the onion on your own. And then if you don't have the bandwidth to do that because you're a solo GP and you're going out, you're still out in market trying to raise assets, I think that's when you can get an extra set of hands to kind of set up some type of venture partner program or some venture fellow program where like it's a win-win, right? Like these students, they get a lot of value, they get some work experience, they get to actually get some hands-on learning in exchange for you actually getting some time back. So you can just go out and raise more assets to possibly hire those people.
Right. Well, no,
Yeah.
that's an interesting thought. So it kind of leads into also one of my other main issues that I was going to call
Yeah.
out too. So I think, I come across a lot of early stage managers that are thinking through the capital fundraise process
Mhm.
10 times more than they've thought through the investment due diligence process.
Got it.
And so when I see that, and it's not necessarily unhealthy at a certain point in time,
Mhm.
it's just if that is the model, right? What you're describing is more of a broker model
Yeah.
than a investment advisory model.
Mhm.
So if your heart is really in the networking and in pulling in relationships, sourcing of deals,
Mhm.
I would suggest thinking about success-based fees
Mhm.
and really steering more away from the regulatory hurdles that come
Mhm.
more with having to set up funds and
Yeah.
be
So
a key
are you talking
person.
about like, syndicate managers that are going out to just raise the syndicate, but maybe the deals are kind of horrible deals?
I mean, yeah, they
Yeah.
avoid the risk of if it
Yeah.
is a horrible
I mean, look,
deal,
there's
right?
managers that have raised, probably half a billion to a billion, and the strategy is asset gathering, right? So the performance may be kind of the table, maybe the standard performance, but they can outperform in raising assets because at the end of the day, it's a chicken and egg, right? You need capital. If you don't have the capital, you don't have the resources to kind of source and screen great deals and hire talent.
Sure.
But to your point, right, if the only purpose is going out, raising assets, and you're really good at that, but then all your deals are horrible and your performance, takes a huge hit, then you may not have a fund 3 or fund 4, right?
Right, right. And I mean, look at the example that you were describing where you are sort of just raising capital for lower return fund, right?
Yeah.
If you are truly just focused on the raising capital portion, you'd be better suited not just doing it for one fund, but dozens of funds.
Yeah.
Because after that fund closes, there's not.
You might as well just be an IR professional and
Right,
just
yeah.
do it. Yeah, to your point,
And
yeah,
it's-
be
it's-
like a
it's-
IR.
Yeah, I mean,
practice.
yeah, broker really. I mean, you're if you look at the return on investment too for what the businesses are,
Yeah.
like you can make even more on a brokerage arm doing
Sure.
just that if you're expanding your network out to multiple funds.
Mhm.
So it's, I have some brokers as clients that are charging like astronomical fees,
Yeah.
and it's just because they're utilizing a great network of principals and chief investment officers to source great deals,
Yeah.
and they're just generating really high return, and they don't need to set up a fund and necessarily be the guy saying this is the best thing for you or it's going to earn you all this money. Just connecting the dots, they're earning more money doing
Yeah.
that than investment advisory business.
I spoke to a few brokers before. One in specific that was in our cohort recently, and behind the scenes when I was talking to this person, she's very wary of venture. I mean, it's just hard in this climate to just go out and raise venture. I think the fundamental issue is the lack of liquidity, right? The capital is locked up for so much time. Although we have secondary markets, you're still dealing with an illiquid asset. And these brokers have gone out and raised billions of dollars of capital for public markets and also for private credit, private equity, because I think there's, obviously, those businesses, essentially when you look at like private equity, those businesses are already profitable, right? They're showing EBITDA, and there may be opportunities to kind of, deliver some liquidity or some distributions throughout that fund life cycle where, your capital is locked up unless you leverage the secondaries. So I don't know okay, so let's talk about just any comments you have to that, and then just maybe some of the pitfalls with maybe retaining brokers, because obviously when you retain a broker, there's a commission that you have to pay, and that might eat into some of your balance sheet as well.
Sure,
right?
sure.
Yeah.
So two issues, right? So I think just going off the broker one, because that was more tied to the last discussion, I think a lot of early managers have a little bit of an over-reliance on placement agents and brokers really to help raise capital, and I think that might stem from the idea that there's just thousands of them, which is true. So they
Yeah.
assume that they're not scared of venture. And it's not just venture, it's really other sectors as well, depending on who the fund manager is. If you don't have a good track record, a lot of placement agents aren't going to really even want to take a look at you.
Yeah.
So, I think it's a misconception that's also based on a misconception that early managers have about the span of the private equity market itself. Like, as I'm sure you've come to recognize too, it's a small world that we live in, that
Sure.
people who work in the space, like you meet somebody the next year, chances are you're going to see them before the next year. Like, it's
Yeah.
a small world. So, I think it's not an infinite pool of capital that's out there, right?
Sure.
So I think expectation setting kind of is important. It goes to our first point too about the amount of capital you want to raise. So if you go into this thinking, I will not have help, I will not have a broker, I'm going to have to go out there, even if I'm purely focused on investment, due diligence, and sourcing the best deals. Even in that world, you got to go out there, you got to meet people, you got to convince people that your strategy is a better mousetrap than the other fund that's doing something very similar.
Yeah.
And that's kind of where the rubber meets the road. If you can do that successfully, you get some good investors that really trust you. The returns should be there. That's kind of an assumption if you're doing your job right. And that's how you start to really get investors that are interested in fund 2 and fund 3. So, that's kind of the broker point in a nutshell too. And there was another question you had too in there, right? There was a...
I forgot actually.
Fair
Yeah.
enough.
But you know what? Maybe we'll recap it in the comments. Yeah, I'm trying to think of what it was. Anyways, one other point I was going to talk about was the venture partnership agreements. There's regulatory, thoughts around that, right? In terms of like how you compensate a venture partner. But I think there's also employment issues too, right? So,
Oh, yeah.
so we might have to loop in another partner for considerations around that. But there's a whole swath of just
IP.
things you got to think about for HR, right? I mean, can you hire free interns? If you pay them with carry, what all? So we may not be the experts to talk about that stuff, but one thing that I shared in my newsletter was just kind of a quick blog on a couple considerations to think about. So that was really helpful. The Nixon team put that together, so I'll hyperlink that in this episode. But I'll try to think about my question in the meantime. Maybe 2 other hot mistakes that you're seeing overall with managers.
Sure. I think this is really my 5th big one that I was going to mention, the operational capabilities of early managers. I think in general, there's almost like an assumption that you don't really have to be good at operations and sort of execution and figuring that part out. It's really a mistake. I think early managers could utilize networks similar to yours in particular, where they have people who are maybe just middle market managers now. They're on fund 3 too. That type of connection and relationship with investment advisors that have been successful is probably the most important thing you can do besides just picking good investments. Now, I mean, I think if you look at them as just your competitors, you're shooting yourself in the foot.
Sure.
Like, it's important to go to them, talk to them, understand what they're doing that works well and that they have found is really good for them. Maybe it's a certain type of due diligence tool or platform. Maybe there's some type of AI functionality that they found has been really helpful for their business. But if you can really learn from the people who have already done what you're trying to do, I think, and a lot of them are willing to teach. Like a lot of them aren't like, oh no, I'm not going to talk about how I send out reporting to my investors, or I'm not going to talk about how we source deals. Like no, like that's like they all love talking about that.
Yeah.
Stuff.
So venture, I would say, when you get to Series A, I would say, some of the elbows may be a little sharper because people are trying to, have more ownership and they're trying to, lead the deal. I would say, even with Series A or even earlier with Series A, I do see a lot of collaboration in venture. So it's not rocket science, right? I mean, people are sourcing deals, they're finding investments, they're doing the research, and hopefully you'll find out if you're right 10 years from now, right? So I think they're all trying, and that's one big thing that has been our mission at Sutton Capital, to kind of build a community and build a support group. The managers, what they get out of it is the managers get to meet other managers, talk about who their fund admin is, and I would say too, I want to lead into the LP point as well, the LP's perspective. But one other thing I want to say is, you know, you mentioned that it's a small community. So if you say something to one person and then, you know, that's changed when you say it to someone else, it's a high likelihood that those people are going to grab cocktails. So I've heard feedback from 2 or 3 people about a specific LP. And the same thing about, you know, maybe an LP that's heard different things about managers as well. I think a big concern too is like when managers name drop. So they name drop that they're, you know, they know a certain public figure or something like that, and that public figure actually doesn't know them. So I think that's kind of a concern too. So so I wanted to plug that, you know, mistake or just red flag. So maybe one more if you got another one. If not, we can talk about maybe the LP's perspective and what the LPs are telling you.
Yeah, so I mean, I guess just on one other thing that I think we were kind of hinting at too, in terms of the amount of discussions you really want to have about people who are investors in your fund or people in your network, you know, I think it's important, like there's an exception, right? If you have an investor who's a big family office and they're like, yeah, talk about our involvement, we want to get out there more, sure. But if it's the type of thing where you have some maybe big investor that is taking a flyer on you, right? Like you don't necessarily need to be going out there and telling everyone who that is to kind of drum up more investors. Like have that conversation with the investor first and try to feel out like, is this something they want to be known in the market for doing before it's kind of publicized? Yeah,
it's a two-edged sword, right? So I think to raise those assets, a lot of times people want to know who's coming along, right? So I think if you could get that logo on there and say, hey, this endowment committed, or hey, this family office, they're a beverage family office and they like that we're doing consumer brands, they took a flyer, but you know, get consent from them in writing that we just got, you know,
it doesn't even need
permission.
to be in writing, right? Like just, I mean, I would just have that conversation up front at that point, you know. But yeah, I think that's probably one of the best pieces of advice too, because I've had clients who kind of have ruffled feathers is kind of how I would put it. And that ruffling of the feathers is the exact opposite thing you want to do to an investor that you want to have for life. Right?
Sure.
Like if something ever gets ruffled, you give them money, you make it unruffled. Like, don't go in that direction. So hopefully that good 5 or 6 different issues at least. Maybe I think we went over that, but hopefully it's helpful.
I think we covered a lot of stuff. I think maybe if you got one more bullet or two on just maybe 2 hot perspectives from the LP side. That way these managers that are listening, they can kind of be aware of that as well.
Yeah, so real quick, 2 hot takes, because we do have to run. We have another call right after. But so 2 quick hot takes from the investor side is really, it's similar to the fund manager side because you're sort of doing investments, but the due diligence of what you're actually investing in, it shouldn't just be like a free riding type of situation where you have a lead investor and you're going to only write follow-on checks. If that's the case, fine. But like, again, there needs to be a strategy. There needs to be some demarcation between the ones that you do invest in and don't. That's not just your gut, you know. And the gut is great. I've seen it work a lot for early managers. It's just to get to that next level where now it's not just 6 zeros, it's 8 or 9. Right? You got to kind of think a little bit more systematically. And then the other thing I'll mention for investors as well is trying to understand different ways of structuring to try to avoid different tax drag situations. And if you're a family office, there are other employee considerations that you mentioned as well. So thinking about how to structure different compensation packages could really go a long way to helping you keep down costs, which is really, as a family office, one of your main concerns too. So hopefully that helps.
Awesome. Well, hey, thanks a lot. Hope you guys got some value and appreciate it. All right. Thanks Matt.
Yeah, it's been
appreciate
great.
it.